Hi, good afternoon, good morning, wherever you might be. My name is Doug Lamb, and I'm joined by John Neal, Benton Blaine, and Mark Krumkowski. On behalf of McGuireWoods and McGuireWoods Consulting, we're pleased that you could join us this afternoon and morning for our Opportunity Zone presentation. For the next hour, we will be walking through a slide deck and posing questions. I will serve as a quasi-moderator with John and Benton and Mark and posing questions throughout as we walk through the slides. But we ask you to please submit questions throughout. We will try to answer them as we proceed. And we, again, thank you very much for being on this. To start, we'll do a round of introductions. Again, I'm Doug Lamb. I'm in our Richmond, Virginia office. I'm a partner in our public finance group and work on tax advantage financing.
I'm John Neal. I'm a partner in our business tax group here in Richmond, Virginia, and I work on transactional tax planning and joint ventures.
And this is Mark Krumkowski. I'm a partner in our Chicago office. I'm the head of our fund formation. I'm in the private equity group. And we both work on fund formation as well as sort of alternative type of financing to private equity funds and private equity companies and similar types of investments throughout up and down the capital structure.
And finally, this is Benton Blaine, Vice President in Atlanta for McGuireWoods Consulting. I focus on tax and non-tax incentives across the U.S. with the goal of getting our clients upfront and recurring costs down as low as possible. So, Doug, back to you.
All right. Thank you, Benton. Thank you, Mark and John. As we talk about opportunity zones today, I would orient you towards the agenda we have in our slides to explain that throughout this presentation, you will hear numerous uses of defined terms that we have attempted to put most of them from the statute and the regs into this presentation. There's a lot of similarity between not only the definitions themselves and the names, but also some of the concepts with some important nuances to pay attention to, particularly as you think about items such as the substantially all test that applies. Over the past 2 years, basically, since this Tax Reform Act came into play, there has been a lot of writing about the opportunity zones. Recently, I think there's been a ton of writing about whether or not the Opportunity Zone program is attracting the type of investment that was originally expected. And unfortunately, too, there have been a lot of stories recently, including in the New York Times, about whether or not some of the fund designations were done in a manner that otherwise one would hope they would have been done. So as you read, it's important, I think, when one is looking at these investments and these opportunities or structuring one, to be aware of what's going on in the community and be aware of some of that, because I think it plays not only into how you approach these and the care that should be taken, but also some of the items we're going to talk about today, particularly on the structuring considerations and to try to eliminate any sort of, to minimize the risk to the greatest extent possible. So when the Tax Reform Act came in 2017, the Opportunity Zone regs, the first set of which came out in October 18, the second set came out in April of 19, along with different notices and revenue procs and facts and questions and frequently asked questions have all been posted on the IRS website and are available. The regs are very lengthy, but are very helpful in terms of providing a ton of flexibility that we will try to highlight as we go through this program. And then additionally, they provide a lot of examples that are helpful, as do the FAQs. So be aware of all those items as we go through these. The purpose of the program obviously was to stimulate investment in distressed areas. The opportunity zones that nearly amount to 9,000 are throughout the entire U.S., D.C., and territories, and you can find the zones on the Treasury CDFI Fund website, and also it's important to know that when you go there, you can determine the validity of the zone for a particular address, so you know that the property is in the address. And just a note of caution on that, sometimes the actual street address does not line up with the actual location on the ground, as you might be aware, so you'll want to always double check to make sure the street address or the information you use to enter it lines up. So in the next few slides, we can talk about the Opportunity Zone fundraising numbers. And Mark, I would ask you, what is the pace of formation of Opportunity Zone funds in 2019?
Yeah, thanks, Doug. I mean, it obviously, what we attempted to do, and this was sort of a chart based on some market information that we have, some public information from disclosures, but we really wanted to show the magnitude of sort of the dollars of people, at least fund managers, who are calling themselves opportunity zones. And frankly, I think at the end of the day, the number is probably larger than the 14 billion we have here. But obviously, it has really taken off. Expect the fourth quarter to be more for a variety of the reasons that we'll go over, of course, and also some timing issues of just the natural timing of how long it takes to fundraise. But we think there'll clearly be more opportunities in the fourth quarter of people pushing, as many of our clients pushing to have a close before December 31st. And then I think for those who might be new or might be looking at this or just recently made a decision, I think there will still be opportunity after December 31, 2019. It'll be slightly different, but I think there'll still be opportunity after that initial deadline. Okay,
great. Thanks, Mark. That's extremely helpful and good information. As one looks at these slides, you can see the increase in activity that's helpful. The next few slides are here for your to illustrate where these zones are located. As mentioned earlier, to go on the CDFI Fund website, and there are other services as well, but the official geocoder confirmation is on the CDFI Fund website. But these illustrate the actual areas where the zones occur and where a lot of this activity. The zones were all designated already, and so that time has passed in terms of the zone designation. So there are three basic Opportunity Zone tax incentives. And as we talk about these, bear in mind Mark's comments about 2019, because that will have some impact on how folks view this I call it a program, but view this tax benefit. The Opportunity Zone program provides three tax incentives for a taxpayer making qualifying investments of realized capital gains in a QOF, the Qualified Opportunity Fund. There's the deferral, the partial gain exclusion, and then the no tax on appreciation in the QOF investment. For the deferral, a taxpayer may elect to defer tax on realized capital gains invested in a QOF until the earlier the day on which the taxpayer disposes of the investment in the QOF, or December 31, 2026. The partial gain exclusion is after holding the QOF investment for at least 7 years, the taxpayer may permanently exclude from tax 15% of the original capital gain invested. So, John, can you tell me how the 15% rule plays with respect to the 7 years and the December 31, 2026?
Sure. So because the statute has a date hardwired in as it relates to the end of the deferral, which is the first benefit under the program, so basically deferral will end at the earlier the date the taxpayer disposes of their investment in the QOF, or December 31st, 2026. And at that time, if the taxpayers held their investment for at least 7 years, they will experience a reduction in the capital gain that they otherwise would have recognized by a total of 15%. And that's achieved through a basis step up in their investment, 10% after holding the investment for 5 years, and then another 5% after holding for 7 years. However, the 5% basis step up will not be available under the statute as currently written if the taxpayer has not made an investment of qualifying capital gains into a qualified opportunity fund by the end of this year. And so come January 1st, 2020, the only deferral or the partial gain will be limited to 90% of the original gain rather than 85% if the taxpayer holds the investment for the 5 years. And so there's been a lot of activity, I think, and discussion around how to get an investment, if you have capital gains, into a qualified opportunity fund by the end of the year in order to maximize the Opportunity Zone benefits. And then similarly, discussion around whether there would be any appetite or ability for Congress to amend the statute to provide for kind of a 7-year period without being tied to the 12/31 2026 deadline.
Great, John, and that's very helpful. And I've got a follow-up question for you there before I turn to Benton for a question. So if somebody wants to hold, they create their QOF in 19 and it's all established correctly, and they hold their investment through 2042 and dispose of it then, what happens?
So at the end, if you hold the investment for 10 years, or at least 10 years, and the proposed regs allow taxpayers to continue to hold their investment beyond the 10-year window and until 2046, and at that time, when the taxpayer disposes of their investment in the QOF, they have the ability to make an election to step up their tax basis in that investment to current fair market value, which it has the effect of eliminating any gain on the appreciation in the taxpayer's investment in the QOF. And so that, I think, to a lot of people represents potentially the biggest component of the benefits in the Opportunity Zone program, provided you have a good underlying investment.
Right. So, Benton, I would ask you, if somebody's trying to maximize that investment return, what can they layer on top of an Opportunity Zone to achieve that benefit?
Yeah, Doug, and I think that is a great question. Certainly we're on this call today to talk about Opportunity Zones, but there's going to be a litany of other federal, state, and local, both tax and non-tax benefits that a company can avail themselves to. If helpful, do you want me to go ahead and work through those?
Yeah, please do.
Yeah, so on the federal side, and I think it's important to keep in mind what is your project. So we've got investment tax credits, work opportunity tax credits, which, believe it or not, there's still a host of companies that are not taking care of those WOTC credits, especially if the end result or business is going to be hiring disabled individuals or veterans, those in distressed neighborhoods or low income. You certainly need to be looking at those WOTC credits. And finally, R&D. On the state and local side, we're going to break it into above or below the line tax savings. So, your property tax abatements, sales tax reductions, exemptions, sharing agreements, withholding taxes, income credits, you name it. And then we're also going to see a number of benefits on infrastructure improvements. So that's roads, water, sewer, power, both in the extension of those services and then reducing the cost, both again for those extensions and then also recurring costs. So that can be a simple way of say there may be a benefit of just lowering your water or your electricity bill for that facility. And then finally, we're also seeing benefits for certain projects associated with, your permitting cost, impact fees, and construction costs. So again, each one of those is going to target itself at a specific kind of project. And to kind of talk through that, if you're looking at a solar investment, because that's a market that's really booming in the Southeast, certainly you want to go after that federal investment tax credit. But make sure you avail yourself to that local property tax abatement, because that's going to run you somewhere between 1% and 3% of your total capital investment and cost per year until that property is fully depreciated. So again, not going to get that kind of instant pop like we would on an opportunity zone, but over that 7 or 10 years, we're going to see a significant cost for the project. So I'll kind of pause there.
That's great. That's extremely helpful, and I think it plays perfectly into sort of the next slide, which is, in speaking about benefits, John, perhaps you can walk us through how the statute would work with a particular investment.
Certainly, Doug. So this is just kind of a high-level example to try and illustrate the combination of the benefits of an investment in a qualified opportunity fund. So in this example, you have an investor who realizes $100 million of capital gain in 2019. They then invest that gain into a qualified opportunity fund and make a timely election to treat the investment as an interest in a qualified opportunity fund. 10 years after holding the investment for 10 years, the investor then sells the interest in the qual for $200 million. And so in looking at the tax consequences, both with and without the opportunity zone benefits, we can see that in the tax on the original $100 million in gain, an opportunity zone investment would yield only $17 million in tax on that $100 million in gain, and that would be calculated by reference to $85 million as opposed to $100 million of gain, because the investor here has held the investment for over 10 years, and therefore they've gotten the benefit of the 15% reduction in the the original gain that is subject to tax. And then on the appreciation, the $100 million of appreciation that in their investment, when they sell it after 10 years, they pay no tax on that. So the total tax associated with their qualified opportunity fund investment is $17 million. You compare that to a similar investment that does not qualify for the opportunity zone benefits, and the investor would pay capital gains on their $100 million of the original gain for amount $20 million. And then on the second $100 million, they pay another $20 million in capital gains for a total of $40 million. And so you can see the after-tax cash proceeds between the qualified opportunity fund investment and the non-qualified opportunity fund investment is pretty material. And this example does not take into account the time value of money benefits associated with the qualified opportunity zone investment, because the investor in that situation is paying the tax in 7 years with respect to the original gain, as compared to paying that tax on the $100 million in gain in the year one without the opportunity zone benefits. So you can see how quickly the opportunity zone benefits can magnify the return on an investment when structured to qualify for the opportunity zone benefits.
That's great. And Mark, I would turn to you and ask, in this sort of example, if somebody showed up and said they wanted to form the fund, just from a practical side, how long does it take you to set that up and go through that process?
Yeah. So from a very pragmatic standpoint, to get the initial pieces of paper that we need to make sure we can qualify and file the forms and check the boxes, we can do that, in as short as a week, from a more of a disclosure standpoint, and sort of multi-investor, and obviously there are still securities laws that everyone needs to comply with. I think then we're talking clearly more of a 2 to 4 week process, just to make sure if we're talking about something relatively straightforward. And based on where we are now, most fundraisers are more of a 2 to 4 month process, because often the fund managers are coming with some idea but haven't fully developed or fully determined where they're going to be or the scope of the project. So the short answer is there's a lot of things we can do very quickly, and not only obviously the four of us, but the entire sort of team at McGuireWoods, corporate tax and otherwise is sort of stand ready and have turned things very quickly to meet various deadlines that we have. But then also we're ready with respect to securities and general compliance, which I think at the end of the day is very important, because you certainly have a lot of new entrants to the market who are sometimes blissfully and sometimes not blissfully unaware of sort of all the other rules and regulations that surround sort of any type of not only opportunity fund, but any type of what I'll call private equity. And by private equity, I really mean all sorts of private investment fund and sort of the rules and regulations around it. So long-winded answer to the question of we can set it up quickly, but there's a variety of issues that need to be addressed of how, frankly, how the profits will flow in the future and things like that beyond the mere tax issues.
I agree, and that's a great point, Mark, and particularly as we continue on, because the diligence that's required not only on the investment, that where the gain comes from that's invested into the fund, the ultimate uses of the fund proceeds, and compliance particularly, really make this a different sort of animal than a lot of other tax vehicles. I think a lot of us have thought of this as a type of item that makes a good project better, but maybe not a bad project good. So with that in mind, in the diligence aspects of it, we're going to talk a little bit about the gain attributes that have to be present in order to avail themselves of the Opportunity Zone benefit. And it has to be a realized capital gain. And it's only capital gains realized prior to 2027. So you hear a lot of dates regarding Opportunity Zones, everything from the 2040s, before 2047 to this 2027. These are important dates to keep in mind, and all the timing rules that come into play. So only capital gains realized prior to 2027 are eligible, and they have to be timely invested in the QOF. The eligible capital gains include short-term capital gains, long-term capital gains, and Section 1231 gains that are treated as capital gains. For example, gains from the sale of depreciable property in excess of prior depreciation deductions. Ineligible gains are things realized from the sale of property to a related party, and also keeping in mind the 180-day deadline that the investor must make a qualifying investment within 180 days of realizing the capital gain which the investor is seeking to defer. And on that 180-day rule, John, I would ask you, are there some particularities of the 1231 gain issue that play into that how you assess that 180-day rule, and also with pass-through entities?
Yeah, no, Doug, that's a great question. There are two notable issues there, or considerations in calculating that 180-day reinvestment deadline. The first is if the investor's gain is attributable to their interest in a pass-through entity like a partnership or an LLC classified as a partnership, then the investor has a choice. They can use the 180-day deadline starting from the date that the partnership realized the gain, or they can use the end of the tax year. So say you have a calendar year taxpayer partnership, when the investor gets their K-1 or the tax year ends for that partnership, their 180-day deadline can begin at 12/31. And so you effectively have a choice there. And then the other item to keep in mind is with respect to 12/31 gains, the proposed regs have a different treatment as it relates to 12/31 gains as compared to capital gains generally, and that is 12/31 gains have to be netted against 12/31 losses. And so and a taxpayer is not going to know that until the end of the year. And so you're effectively forced, if you're relying on 12/31 gains as the vehicle by which you intend to make an investment in a qualified opportunity fund, you at least under the current regs, you have to wait until the end of the year. And so that is something that I think a lot of folks are hoping Treasury will address, or either in the form of modified or updated regulations to kind of put the 12/31 gains on the same footing as capital gains generally, which is looking at gross 12/31 gains. But that's something to keep in mind depending on the source of your gains for the investment.
Great, thank you, John. And in terms of what a QOF is and what qualified opportunity zone property is, the QOF is an investment vehicle that's a corporation or a partnership that is established for the purpose of investing in qualified zone property. You can use existing entities, and we can talk about that a little bit later, but there are some rules that have to be followed there. But there is a particular important rule that you can't be formed for the purpose of investing in another QOF. And then the QOF has to hold at least 90% of its assets in the qualified zone property. So this 90% test is determined by the average of the percentage of the qualified zone property held in the QOF on the last day of the first 6-month period of the QOF's taxable year and on the last day of the QOF's taxable year. We won't get into the interplay of those two, but you can just see that it can result in some timing issues there in terms of how that test plays out. Obviously, QOFs can self-certify. That's been addressed, and that was one of the attributes of the statute that was recognized early on. Qualified zone property is qualified zone stock, partnership interest, or business property. And for the just sake of collapsing the stock and partnership interest test, we will go through it that the partnership, they're basically the same test. They have to be acquired after 12/31/17 at original issue in exchange for cash. At the time it was issued, the corporation has to have been a qualified zone business in the case of a new corp, or was being organized, or in the case of a new corp, was being organized for that purpose, as I just mentioned a moment ago. And then substantially all, and this is a 90% test, and this is important. We talked about, I think, at the beginning, just keeping track of the substantially all rules here, because there's a 90% and a 70%, and then a place where you can, basically take the product of the two and come up with 63. And you need to be aware of these different tests, because the substantially all test for the QOF's holding period is at that level, and the 70% test we'll talk about later is sort of use of the property. This next slide just goes through the same attributes for the qualified zone partnership interest, and then this next one on the qualified zone business. This is a critical part of the analysis in any of these structures, and it has to be a trade or business in which substantially all, and here's the 70% test of the tangible property owned or leased by the taxpayer is qualified zone business property. And then the first test is the 50% gross income test. At least 50% of the total gross income of the entity is derived from the active conduct of that trade or business. We'll talk a little bit more about how to apply this test and some of the rules around it later. Then there's the intangible property test, which is a substantial portion of the 40% here of the intangible property of the entity is used in the trade or business. And then the non-qualified financial property test, and that non-qualified financial property stuff like debt, partnership interest, stock. Less than 5% of the aggregate unadjusted basis of the property of such an entity is attributable to non-qualified financial property. And then the sin business test, which basically excludes, suntan facilities, gambling facilities, and country clubs, massage parlors, that sort of thing. Probably a lot of you are familiar with these tests. They're rooted in other areas of the code. They've been around for a while, and there's a lot of writing about these. So it's important in realizing the Opportunity Zone statute. It definitely pulled from a lot of different areas of the code and how it was put together. Insofar as you have qualified zone business property, it is tangible property used in a trade or business if it's acquired by purchase after 2017. Such property was acquired by the QOF by purchase after December 31, 2017. The original use of such property in the zone commences with the QOF, or the QOF substantially improves the property. And the substantial improvement test is important. It adds a lot of flexibility to the statute, and I highlight that here for this point, but we will talk about it as we proceed further. The substantially all test here is 90% of the QOF's holding period for such property is that all of that property was used in the zone.
And Doug, I'll just add, I think one takeaway for, depending on sort of the audience and where people are in the process is, the idea that a fund manager or developer or whatever nomenclature you'd like to use for a particular property, that they're going to somehow shoehorn some older properties that they have into this, is just not. Is not the purpose of it, doesn't fit within the regulations, and becomes a, potential not only for the fund manager, but for the investors to not get what they thought they were bargaining for along the way.
Right, and so that's great, Mark, and I think that plays into sort of Benton. What can you talk to me a little bit about what you see that these types? I know you mentioned it earlier a little bit, but the types of projects, the benefits, and particularly any risk and compliance issues as you approach one of these investments.
Yeah, absolutely, Doug. So I think it's important, and the analysis that we take is looking at the costs that are associated with that project and then seeing what we can offset. So I mentioned solar earlier, but let's take another one. So mixed-use development. So as long as it's not going to have that sin business that you mentioned, in that situation, we're going to target property tax abatements. We're going to look for reduced permitting and impact cost, ingress and egress. And there may be a situation where, depending on the size, there may be a partnership opportunity with the community for a parking deck. So we just finished one of those. Another thing that we're seeing right now is multifamily apartments. That seems to be a hot market in most cities as well. If you can work in and there's that need for an opportunity zone. So in that situation, we're seeing a couple communities target property tax abatements for the multifamily, especially if it's associated with student housing. We're seeing it for certain types of medical office if it's not already there in that community. And so that can range from, the large hospital providers, cancer treatment centers, all the way down to some of the more specialty facilities, again, if it's not already in that market. So I think the key there is understanding what your project is, what cost are you going to pay, and then we work backwards and see what we can offset. Now, two important pieces of that, we can break all incentives down into two categories. So one is going to be by right, which means if you check the boxes, you get the benefit. And that's generally, we're going to see that with our federal tax incentives, so investment tax credits and WOTC. You know, if you spend the dollars or if you hire the right employees, you get that benefit. The other one is that we're going to talk about is discretionary or negotiated incentives. And these you need to do up front. So if we're going to get those reduced permitting or sometimes expedited permitting is the biggest thing you can get for a project, utility cost reductions, tax abatements, things like that, we need to negotiate those in advance. So generally, sometimes before we break ground, before the property changes hands, think of it this way. You need to have the leverage to where you can go to that community and say, you know, hey, I need this benefit to make this project happen, and they can justify it to their taxpayers or ratepayers. So generally, the earlier in the process, the better. So we can break it into those two categories. And then the second piece you brought up, Doug, was the compliance. So, you know, when we're looking at those by right incentives, it's generally much easier because you've already complied with them before you're going to get the benefit. So we've hired the employees or we've spent the capital, so we fill out the forms and generally take that on our tax return. On the second piece, the discretionary incentives, or negotiated incentives, whatever you want to call them, those are generally going to have some sort of performance agreement. So there's going to be clawback risk. So, you know, if you get a property tax abatement or they're going to waive that $250,000, you know, water line extension cost, they want to know that you're going to be there for the long haul. And that generally ranges from somewhere between 3 and 10 years for the life of the project. If you move the project, you fire the employees, or you move the equipment out, you could be on the hook for then paying whatever benefits you got, sometimes with interest and fees associated with it. So a lot of people don't understand, though, that these performance agreements and clawback risk, you can negotiate those as well. So those aren't set in stone. You know, I think it's important for companies, once they get in there and begin that negotiation process, to understand where there's give and take through that, because ideally you want to have your clawback for as short as possible. You want to negotiate any pro rata provisions. So if we finish our investment a day late or we come in just $1 short, we're not on the hook for paying back the entire incentives, maybe just a small marginal amount. And then finally, the length of these. You know, we don't want to see 10, 15-year agreements. We like seeing 5 years or less. And again, that's a piece of negotiable that we're going to do on a case-by-case basis. So that's a general high-level overview, but make sure if you avail yourself to these benefits, you assign somebody within the company who's monitoring and tracking these. I see countless companies who can claim sometimes hundreds of thousands of dollars of WOTC credits, or they spend a lot of time negotiating their property tax abatements, and then by the second or third year it just falls through the cracks and nobody sends in the form. So whether you're working with a third-party provider like us or doing it in-house, you need to make sure that year over year, even with turnover, attrition, retirements, somebody is managing those programs and you're taking advantage of the benefits that you fought so hard to get. So I'll kind of pause there, certainly answer any questions if you have them, Doug.
Well, I'll just supplement a little bit, Benton. I think, one, since I know you've helped me and helped the firm on a variety of issues like that, one of the things that you've done is sometimes come in and done that sort of preliminary audit to help people move that process and making sure they're taking advantage of it. So I will add, I know it's self-serving, but I will add that to the call and for the benefit of our audience. The other piece I'll add, which was something that recently, I guess, has been brought to my attention. I hadn't given it thought by a fund manager, which was, and this was within the multifamily housing situation or industry or subsector, and we have a significant presence of that in the Southeast, and a variety of attorneys that work out in California and New York as well, and I'm sure many of our other offices as well. But those three groups, and one of the things that was an interesting piece that I'll share with everyone and sort of have people think about it a little bit is the areas were essentially, and we can argue about whether there were some modifications, but essentially based on the 2010 census tracts. And anyone who's in a big city or in a small city for that matter know that, within certainly less than 9 years, certain parts of cities and certain areas and towns can drastically turn and transition one way or the other. And so I think there are a variety of fund managers who are looking at what I'll call is looking at transitional space that clearly has turned or is about to turn and seen an advantage or an opportunity maybe to sort of use that transition area as well as these benefits to maximize, what they will consider a good investment. So I guess I put that out for thought and consideration for our audience, and but it was something you had touched on, and I know we had talked about it in the past as well.
Well, and I think that's great, Mark, because there are a couple points there as we'll talk about some of these right now, and the next few slides talk about regulatory guidance, and then we get into some structures. And in light of the timing, what we'll try to do is address a few of these with some questions, leave the sort of fine detailed reading to the audience, but a couple of points that have been made are on the compliance is that the diligence, the follow-up after the investment in these types of benefits is really critical because it's not similar to some where once the original investment's made, there's not a risk of something after it happening affecting that. So a very important aspect of how one addresses this. And among the recent regulatory guidance, there's been a lot of clarification on a number of items related to the business property, how leases work with these requirements, and then, as I mentioned earlier, the safe harbors. And in terms of tangible property previously used in the Opportunity Zone, John, walk me through the 30-month period test and the investment needed in that period to the property to qualify.
Sure. So if you have used property, tangible property, rather than new property, which is often going to be the case, in dealing with acquisition of property in an existing Opportunity Zone that has a building, let's say, and so in order to avail and cause that property to be treated as qualified Opportunity Zone business property, the taxpayer has to double their tax basis in that used property within the 30-month period. And so in this respect, it's important to have an allocation of purchase price to the extent you are acquiring, for example, land that includes a building, because the regulations provide that, as you might expect, that you don't have to, land is not taken into account for purposes of determining whether you substantially improve a property. And so so any amount allocated to the land is excluded, and you're merely having to double the tax basis in the building, let's say, over that 30-month period. And so that's an important feature to keep in mind, but helpfully the proposed regulations go further as well in providing that if you have used property but the property was not previously within an Opportunity Zone, meaning had not previously been used in an Opportunity Zone, and the fund or the QOZB brings that property into an Opportunity Zone fund or into an Opportunity Zone, there's no substantial improvement required, and so that's a helpful component of the proposed regs. And then similarly, with respect to abandoned property, if the property within an Opportunity Zone has been vacant for at least 5 years prior to being purchased by a QOF or a QOZB, that property will satisfy the original use requirement, and therefore you do not have to double your basis in that property. And so that's some really, both of those features are really very taxpayer-friendly and favorable guidance to help facilitate in the program and investments within opportunity zones.
Great, John. And so let me ask you a question. If you buy, the QOF is all set up and it's used to purchase land for $10, and then 20 years later, all it's done is invested $1 in a lemonade stand on the property, and the property appreciates to $400. How is the service going to look at that $1 investment in the lemonade stand?
Yeah, so that's a great question, Doug. So prior to the release of the most recent round of proposed regulations, there was concern that the way the rules were drafted in the statute, that you could effectively do what you were describing, Doug. It's commonly referred to as land banking. And what the regs say is that that's not sufficient in order to qualify as QOZB property. You really have to have a substantial improvement with respect to the land, and in particular, the land needs to be used in a trade or business. And so the investment, to use your example of a lemonade stand, relative to the overall value of the land, that's not a meaningful or substantial investment, and therefore that would not qualify. And so you really have to be cognizant of making a meaningful and substantial investment in the zone without regard to the value of the land.
Okay, great. And some of these other regulatory developments having, as I mentioned, addressed the lease area, and in particular, John, I would ask you, do improvements by a lessee to use property qualify as original use purchase property?
No. So with respect to lease property, the substantial improvement test does not apply. Neither does the original use requirement. So that is a clear benefit to having leased tangible property in setting up and structuring a qualified opportunity zone business.
Okay, and of some of the regulatory developments, one, they address the market rate lease issue and related party leases, and that's what's addressed on this slide and what John just referenced in terms of the substantial improvement requirement. An important part of structuring one of these transactions is the 90% asset test, as opposed at the QOF level, as opposed to the use test at the business level. And the 90% test is measured, as we talked about earlier. The regs provide that a QOF can exclude contributed capital for purposes of the 90% test for 6 months after it's received by the QOF if it's held in cash. Additionally, as we talked about, there are some safe harbors, which we will address real quickly right now, that in terms of a working capital safe harbor, a qualified zone business is allowed to treat its cash equivalents, and debt with a term of 18 months or less as reasonable working capital, provided the amounts are designated in writing for development of a trade or business in the opportunity zone. There's a written schedule pursuant to which the capital will be spent within 31 months of receipt by the business, and the working capital is actually used in a manner substantially consistent with the written designation and schedule. So, John, can you talk to me a little bit about how you would advise that schedule being put together and having it documented?
Yeah, well, I think there's two elements to that I think taxpayers would be well advised to incorporate. One would be entering into that written plan in close proximity to the time by which the investment gets deployed, first into the Qualified Opportunity Fund, but then secondly down to the Qualified Opportunity Zone business, which is where the working capital safe harbor applies. And then secondly, to have a reasonable amount of detail, but sufficient flexibility so as the taxpayer can basically satisfy the third prong of the test, which is that the working capital, it's not sufficient merely to have a written designation and a schedule for which the working capital is spent, but to spend the working capital in a manner substantially consistent with that written designation. So it really, I think, needs to be a mix of reasonable detail while building in enough flexibility to take into account project modifications or project delays, things of that nature that you would typically encounter in developing a project or a business within an opportunity zone.
That's fantastic. And continuing on the safe harbor concept, as alluded to earlier, the 50% gross income test has essentially three safe harbors, any of which can be satisfied. One, and the way to satisfy them is based on the services, which is either hours or amounts paid, and it's basically a fraction system where the numerator is the work done in the zone, and the denominator is everything else. And then the third safe harbor being the tangible property of the business in the zone, and the management or operation functions performed in the zone are necessary to generate 50% of the gross income of the trade or business. And those are three safe harbors. Lastly, there is a facts and circumstances test that applies to satisfy this. There's been additional guidance about specified non-inclusion and inclusion events, which are listed here. We're not going to go through those right now, but it's important to understand that these can come into play in a variety of circumstances, particularly of anytime any sort of estate planning is dealt with and or dealing with contributions of capital to the QOF and how those are assessed. In keeping in that same vein, because I want to skip ahead to the structuring slides, are some issues regarding disguised sales, treatment of the gains after 10 years, and some guidance that probably is expected on aggregator funds for QOF investments and the existing guidance there. So the next three slides quickly go through what we'll call a single-tier structure, a two-tiered structure, which we think is probably more preferential for most, and then the sort of the multi-project two-tier structure. And so, Mark, I would turn to you about unique structures that that QOFs are using in this space, and your views there.
Yeah, so I think the interesting piece of that is at the end of the day, the structures that the QOFs are using are all of the traditional structures that other private investment vehicles have been using. And so there is, some the fund manager through its general partner or other entity is getting a carried interest to promote an upside from the investors. And so I think the good news from not only the fund manager side, but also the investor side is sort of the stability of the market of what those structures look like, what the what I'll call the non-QOF tax issues are that have been certainly well developed over the last 20, 30 years. And so from that point of view, I think the advantage is, for the most part, and you certainly will have people coming up with more complicated structures, but for the most part, they've used traditional structures, which I think has been an advantage to the industry and frankly, the acceptance of the industry as well.
That's great. That certainly makes it easier. I think that's some of the flexibility afforded by this, and again, to highlight that aspect that there is an element, a very important element of this whole benefit that is intended to be very flexible to achieving the tax deferral or exclusion. In these next three slides, I'm going to flip to the second of which is the two-tier structure. And John, I would ask you, just by comparison, because we're getting to the end of the hour, to sort of explain why this two-tier structure might have flexibility over the single-tier structure, particularly as it relates to application of the substantially all tests and the safe harbors, and then perhaps compare it to the multi-project investment structure and the issues relating to redeploying investments when you have an investor that's exposed to the risk of multiple projects.
Certainly, Doug. So in this structure on this slide, which we refer to as the tiered investment, you basically have the investor coming in first with the capital gains into a qualified opportunity fund. And that qualified opportunity fund, in turn, has a requirement that it invests substantially all of its assets into qualified opportunity zone property. And so, if you recall, qualified opportunity zone property can consist of three things. It can consist of a partnership interest that qualifies as a QOZB, stock in a corp that qualifies as a QOZB, or qualified opportunity zone business property itself, meaning the slide that we just went past, where the direct structure, that would be one where the qualified opportunity fund went out and operated the qualified opportunity zone business directly and not through a subsidiary partnership or subsidiary corporation. And so why would you want to do a tiered structure? It's primarily for two reasons. One is, in the tiered structure, unlike the direct structure, the substantially all test effectively gets diluted. And what I mean by that is that the QOF has to, 90% of its assets have to be invested in qualified opportunity zone property. So they would take, let's say, of 100 investment by the investors, they would have to incorporate 90 into the partnership interest of the QOZB LP here. That QOZB LP, in turn, would have to invest substantially all of its assets into qualified opportunity zone business property, which at that level is 70%. And so you can effectively end up with 63% of the investments coming in from the investors within an opportunity zone. And so it provides you a little bit of flexibility, right? So particularly as it relates to qualified opportunity zone businesses as opposed to a real estate project, which the tests are more likely to be easier to satisfy. And so that sort of flexibility is very helpful. And then the second benefit of a tiered structure is that you get the benefit of the working capital safe harbor, that 31-month period that we alluded to earlier. That is not available if you structure your QOZB through a direct ownership by the QOF itself. It's only available in the tiered structure and by the QOZB LP or Corp. And so those two elements alone, I think, really justify using a tiered structure, either as we show on this slide or the multi-project, same approach, except in the multi-project investment you have multiple LPs, and you see some of the larger funds being organized this way, where there's a mandate to go out and acquire interest in QOZB partnerships or LLCs that each will operate their own qualified opportunity zone business. And so, Doug, to your point about redeployment, if you have in a multi-project investment structure, one project that is having difficulty either from a business standpoint or from a qualification as it relates to the satisfying the various tests that comprise the qualified opportunity zone business, you would need to dispose of that particular investment, and you'd have 12 months by which to redeploy the proceeds from that investment into another QOZB or QOZB LP so as not to cause your investors, assuming you're within the deferral period, i.e. prior to December 31st, 2026, so that you can continue to qualify and the investor isn't unnecessarily accelerating their original deferred gain.
That's great, John. And for the benefit of the audience, there's some more material in here, a couple items just to always be aware. We highlighted the diligence aspects. Benton talked about marrying other incentives. All those are important elements in doing this, and also just knowing that the abundance of resources out there, and we mentioned the writing out there, so please continue to pay attention to that. And with that, I would like to conclude and just on behalf of Mark, Benton, John, myself, and McGuireWoods and McGuireWoods Consulting, thank you all for joining. We very much appreciate your attention. Please feel free to reach out with any questions. If we did not answer a question as it was submitted, we will try to follow up and answer it after the fact. Again, thank you very much. Have a good rest of your morning or afternoon.